Welcome to Talk Tickers, your dedicated briefing for extracting the critical signals from earnings calls.
That's right.
Today, we are undertaking a deep dive into Bank7 Core, ticker BSVN. They just had their Q3 2025 earnings call earlier today, October 15th.
And our mission, as always, is to really filter out the noise, get you the essential intelligence. We're going to break down their headline beat first.
Yeah, definitely a beat.
Then we'll dig into management's balance sheet strategy seems almost impervious in this rate environment, and look at the strategic landscape, how they're using capital with M&A looking so tough.
And you saw that in the market reaction, right? The tone was definitely positive. Management called the results very solid.
Yeah, I did.
And the stock, well, it popped immediately. This wasn't just some lucky break, but a structurally strong quarter.
Absolutely. And looking at the actual numbers, the beat was pretty significant. They reported GAAP earnings per share of $1.13.
$1.13, okay. And consensus was where?
Consensus estimates were kind of clustered around $1.03 to $1.66. So, they cleared expectations by a good 6% to 10%, pretty solid.
That's substantial. And the top line, revenue.
Yeah, that followed suit. The revenue proxy, that's basically net interest income plus fees, came in at $25.24 million. The street was looking for about $24.0 million.
So another comfortable beat there.
Right. And the core driver, net interest income, was $23.03 million.
So what's the big takeaway from how they delivered that revenue? Was it just higher rates?
Well, not just that. It really wasn't about, say, financial engineering. It was consistency. Management was quick to point to strong organic growth.
Organic growth, okay.
Yeah, in both loans and deposits. So this isn't just about hitting an earnings number. It's fundamentally about expanding their base, their scale.
And you see that translating onto the balance sheet numbers. Total assets grew year over year, up 3%.
Yep, hitting $1.89 billion. And total loans, they climbed 2.5% to $1.51 billion.
Right. And they emphasize that this organic engine, really fueled by their relationship bankers, is driving it.
Exactly. And what's really interesting here is how that strategy plays into maybe the biggest challenge for the whole sector right now, NIM. Net interest margin.
Okay, yeah, let's definitely unpack the NIM story, because BSVN highlighted a core NIM of 5.07% for Q3, which actually ticked up slightly from 5.02% in Q2. Now, wait a second. Almost every other regional bank is talking about NIM compression. How are they holding up? Is this sustainable?
That's the million-dollar question, isn't it?
Yeah.
Management directly credited their properly matched balance sheet.
Properly matched.
Yeah, they're saying it's not a fluke, it's structural. They've deliberately focused on matching up their high-quality commercial loans, which often float with rates against sticky core deposits.
You mean the deposits that don't just run off chasing yield?
Exactly, those core deposits. And that matching is what shields them, or at least buffers them, from the worst of the industry pressure from rising deposit costs.
So they built the balance sheet for asset sensitivity when rates were going up, and now they're reaping the benefit while others are feeling the pain. Makes sense.
And you see it in the numbers. The net interest spread improved quite a bit year over year, up to 4.10% from 3.78%. That really tells a story about execution.
It really does. Okay, so shifting gears a bit, what about forward growth? Loan pipeline.
They said the loan pipeline remains good, and the target is still for high single-digit year-over-year growth.
Sounds positive, but any caveats?
Well, they did flag one specific risk, something they've managed well this year, apparently.
Yeah.
But it's the potential for lumpy paydowns.
Ah, right. That's when commercial clients suddenly pay off big loans early. Maybe they sold an asset or something. That can mess with your growth projection.
Precisely. But so far, they said the robust, consistent underlying growth has more than offset those kinds of exits.
Okay, and pricing on new loans, what are they getting?
New loans are coming on, they said, between 7.0% and 7.25%. That's slightly below their September average, which is 7.4%, but still pretty strong.
And here's an interesting point. They made the competitive pressure right now.
Yeah.
It's higher on the deposit side, fighting for funding, than it is on the loan side.
Oh, that's key. That suggests they still have pricing power with borrowers.
Exactly, which is a really positive divergence in this kind of market environment. Great news for future earnings.
Absolutely. And that brings us nicely to capital management. Their capital ratios look exceptionally strong. Gives them a lot of flexibility.
What were the numbers again?
Tier 1 leverage.
Yes.
Strong at 12.71%. Total risk-based capital, 15.43%. They definitely have capital to work with.
And they're clearly signaling confidence by putting it to work for shareholders, aren't they?
Seems like it.
They renewed that 2-year share repurchase plan back in August up to 750,000 shares.
Right.
And they also raised the quarterly dividend, 12.5% to $0.27.
Yeah, also announced back in August. Those aren't small moves. They signal real conviction about durable earnings power.
Definitely a firm statement. Okay, let's pivot to credit provisioning. This gives you a window into how management thinks about risk. They set aside $0.7 million this quarter.
$0.7 million. Okay.
But hang on, they also said the actual credit trends look very benign and criticized asset migration was neutral, maybe even slightly positive. So why build the reserve? Doesn't that just drag down earnings unnecessarily?
That's where their prudence, or maybe conservatism, comes in. Management explicitly called it putting the hay in the barn.
Put the hay in the barn? Okay.
Yeah. They aren't provisioning because of current problems. They cited two reasons.
Yeah.
One, just portfolio growth. Bigger portfolio needs bigger reserves.
Yeah.
Naturally. And two, increased macro volatility out there, in the global credit markets.
So it's about the potential future risk, not current losses.
Exactly. They're using their strong capital position now to preemptively build a buffer for potential future bumps, strengthening the balance sheet while times are relatively good for them.
Proactive, not reactive. Got it. So future provisioning depends more on growth pace and the macro picture than today's delinquencies.
Precisely. Okay, let's look forward at guidance, specifically that NIM trajectory. Quarter-end NIM was 4.55%.
Right.
But they do see some slight compression coming in Q4.
How slight? Any numbers?
They guided towards maybe 4.50%, potentially drifting down to 4.47% later in the quarter, mostly due to that continued pressure on the liability side, the deposit costs, even with their matched balance sheet.
Okay, a little bit of pressure expected. What about the fee income side?
Loan fee income was strong this quarter, represented about 40 basis points of the margin.
40 basis points. Wow. Why so strong?
They put it down to a robust deal market and just strong execution by their teams. But
Awesome.
Management views that specific piece as outperformance. They expect it to trend back towards more normal levels.
So don't bake that 40 BPs into your run rate necessarily.
Probably not. Looking ahead to Q4, they expect core fee income, the more recurring stuff, to be similar to Q3. And non-interest expense, they guided that between $9 million and $9.5 million. Seems like tight expense control.
Good discipline there. And one quick note before we hit the bigger picture, they mentioned mortgages.
Yeah, briefly. It sounds like they treat that almost like a relationship service, not a core profit driver.
Because rates are high, deals fall through.
Exactly. High fallout rates, affordability issues. They basically offer it as a niche service, mainly for their high net worth clients.
Yeah.
To kind of deepen the relationship. Not a big revenue engine right now.
Makes sense. Okay, now, the elephant in the regional bank room, M&A, mergers and acquisitions. Management confirmed they're active in discussions, which you'd expect.
Standard procedure.
But they were pretty specific about why deals aren't closing.
Yeah, the list of challenges is pretty daunting. It really boils down to two big valuation disconnects. First, the overhang of AOCI.
Okay, let's pause there. AOCI, accumulated other comprehensive income. For listeners, that's basically the paper losses on their bond portfolios due to higher rates, right? How does it kill a deal?
It creates a huge capital problem for the buyer.
Yeah.
When you acquire a bank that's holding a lot of old, low-rate, long-duration bonds or loans, you have to mark those assets to their current lower market value. It's called a purchase accounting mark. And that mark can just vaporize a huge chunk of the buyer's tangible book value. The capital hit is enormous.
Right, so you're paying for the bank and then immediately taking a big capital charge because of their legacy assets. Ouch.
Exactly. And then you layer on the second issue, unrealistic seller expectations.
Sellers still want high prices.
Apparently. Many are still looking for, 1.5x, maybe even 2x book value, which is just incredibly hard to make work financially when you factor in those potentially massive purchase accounting marks.
So the math just doesn't add up.
Pretty much. And BSVN stressed they're being disciplined, acting like owners, and avoiding deals they called real head scratchers. Their strong capital position lets them just walk away.
That discipline, that ability to say no is actually a powerful signal itself, especially when you look at the stock context.
How so?
Well, BSVN stock has actually lagged the regional bank ETF, KRE, over the last month. BSVN was down about 10.8%, while KRE was only down about 2.8%.
Interesting underperformance.
Yeah, which suggests maybe the stock could be poised for some relative improvement if the sector firms up. Because BSVN's strategic levers are internal now, capital return, not relying on external M&A hopes.
That's a great point. The whole value creation story seems to be pivoting away from potential acquisitions and really focusing squarely on capital distribution back to shareholders.
Right, which brings us to where we connect the dots and maybe explore what an investor might do with this information and the usual reminder. This is absolutely not financial advice.
Definitely not.
Mm.
We're just pitching, let's call them outrageous but plausible scenarios based on the signals from the call. Ideas to think about.
Okay, so what's the thesis here?
It's pretty simple, actually. The market seems overly focused on that slight NIM compression guided for Q4 and maybe completely undervaluing the really strong signal they sent with the capital return program. That buyback, the dividend hike, it creates a kind of floor. And the stock's recent weakness, that dislocation, that might be the opportunity.
Okay, so how do you play that? What's the pitch?
The pitch involves a specific derivative strategy, a zero-cost collar. It's designed to capitalize on management's obvious confidence and that capital they have ready to deploy.
A zero-cost collar. Walk us through it.
Okay. Step 1. Go long BSVN shares at the current price. Step 2. Protect yourself against unexpected macro shocks or, more rate volatility, the stuff hitting the whole sector. You do that by buying out-of-the-money put options.
Okay, long stock. Buy puts for downside protection. But puts cost money. How is it zero cost?
Right. To fund the cost of those puts, you simultaneously sell call options further out of the money.
Selling calls generates premium income.
Exactly. It offsets the put premium. Now, this does cap your immediate upside potential if the stock suddenly rockets higher, but
the justification.
The justification is that huge 750,000 share buyback authorization. That acts like a powerful demand floor under the stock. If the price weakens significantly, management has signaled they'll likely step in aggressively with buybacks.
So the collar helps you capture the benefit of that buyback support near the current price while hedging broader risks.
Precisely. It's a way to align your position with management's own actions and stated confidence, capturing value they create directly via capital return.
Pretty clever, right? It's definitely a thought-provoking structure. Okay, so wrapping things up, Bank7 delivered a very clean Q3 beat.
Yeah. Really solid execution.
Reinforce that strategy of disciplined organic growth, strong capital management, and crucially, that NIM resilience from matching the balance sheet effectively.
We're really focusing on the variables they can control. Credit quality seems pristine, expenses are tight, and they're aggressively returning capital since M&A doesn't make sense right now.
Which leaves us with the final provocative thought for you, the listener, to mull over.
Go on.
Given management's aggressive stance on capital return, that dividend hike, the big buyback renewal, and their very clear disciplined avoidance of expensive M&A, how long can the market keep ignoring the intrinsic value being created just through direct shareholder payouts? It feels like the narrative has to shift, right? Away from hoping for an acquisition premium towards valuing the bank based on pure capital distribution and organic performance.
Yeah, it forces you to look past the M&A chatter, which isn't happening anyway, and focus purely on how effectively they're allocating capital themselves. A different way to value the company.
Definitely something to think about. Thanks for joining us on Talk Tickers.
We'll catch you on the next Deep Dive.